Amazon shares, they are lower this morning. The tech giant provided weak guidance for the current quarter. This after cloud revenue missed expectations. For a closer look at Amazon and more, I want to bring in Brad Erickson. He's RBC Capital Markets Internet Services Senior Analyst. I want to thank you for joining us. So the numbers are down. I think the other big headline, though, is just how much they are planning to spend. It sort of ends, I think, a little bit of the debate around DeepSeek and whether these models are so efficient that we were going to see sort of a precipitous decline in capex spending on infrastructure and chips and the like. So how do you look at this, Brad?
Yeah, good to see you, Andrew. Thanks for having me. Yeah, I mean, Meta started us out, what was it, 60 to 65 billion. Google got us going earlier in the week, 75 billion, and now we're looking at 100 plus with Amazon. These are ginormous numbers. No one had any sort of expectations that the capex guide probably wasn't going up last night. But with that said, you know, the story remains the same for, frankly, all these companies, but Amazon included, is people need to feel comfortable that there's a pipeline of demand, there's visibility to demand that they can generate to pay for all this stuff. And I think, you know, Andy Jassy did a good job on the call last night. He basically said, we have line of sight. We don't make these investments without having line of sight. We're there. So I think you can still be comfortable despite the just sticker shock of how high the numbers are.
Okay, so you look at the stock right now. We're going to flip the board around and show folks where Amazon stands. What is your price target on this company? Call it 12 months out from now.
Yeah, I mean, we took our target up last night to $250, and I think, you know, the stock's trading. I think this morning it's indicating a little bit below 30 times on a PE basis, on a GAAP earnings per share. I think this is a situation where that's a high multiple, obviously, for a stock, but they just grew operating income 82% in the last year. And we think that can at least go up by 20 to 30% for the next few years. And so that's kind of earnings growth we call growing into this valuation, could certainly be higher over time.
So you say 250, we're at 232. What do you think the downside is at this point?
Oh, I mean, I think fairly limited. A lot of people obviously own this stock, so there is some crowding aspect of that. But I think, you know, this is such it's a very large moving ship, obviously. And it's not going to course correct, I would say, on a dime or anything. So I don't worry about some like big shock to numbers upcoming. It's just a matter of whether they can continue to hit those EBIT expectations, maintain that cloud growth. That's actually another piece I should mention is they grew 19% in the quarter. We think they're actually probably maybe going to decelerate a little bit here in the near term, but they have to keep that growth rate, call it high teens, to continue to give confidence that, again, those AI investments are warranted.
So, Brad, there's sort of three pillars to this business right now, and I think a fourth pillar that's coming. There's obviously the retail business. There's AWS, which we're talking a lot about, obviously. There's the media advertising search business. I don't know what you want to describe that as. But there's this fourth one that's not here yet, called Kyper, which is the satellite business, but is coming, or at least we think it's coming in the next year. How is that factor, if it does at all, into your valuation?
Yeah, I mean, at this point, it's hard from a revenue perspective. I think from our perspective, we're thinking about expenses there, something in, call it the low single digits, $2, $3, maybe $4 billion of expenses this year related to rockets. They're going to start going up in March, as you said. So, yeah, I mean, again, clearly they wouldn't be making those investments if the revenue opportunity wasn't there. We don't really have anything, frankly, penciled into our model as of yet.
Do you think you should, though? Because honestly, you look at like SpaceX, and it's just, I mean, it's killing it. And if they can get anywhere even near that, you're going to create an enormous amount of value out of, I don't want to say nothing, but out of all of these investments. But that's not reflected in the stock at all?
I think it's still a little bit too soon to be able to sort of put that into things. And again, we try and measure these things out, right? We know the expenses, which is nice. And so I feel like we're able to sort of set a conservative bar. If and as that revenue comes in, yes, clearly that would be upside in the stock.
What do you think about the retail business? I mean, that is a huge driver of this whole enterprise.
Yeah. I mean, I think there's a lot of good stuff going on there, obviously. I think one of the things that we keyed on last night was for their fulfillment efficiency, right? So how do they raise those margins on retail? They are working on, they're focusing more in 2025 on same day sales, right? So faster delivery times. again, I think that actually has a circular effect of holding up more demand. They talk about, and it's not a secret, delivery elasticity, right? It just means when you look at a product and you see you can get it faster, you're probably going to order it. It's favoring their first party business over their third party. So that's actually, we think, a little bit of why they missed on third party last night. But the overall business will tend to hold up better, I think, such that they continue to improve those delivery times. And they're expected to reduce cost of service, cost to serve, I should say, this year as well. So all of that helps.